Today, we are looking at chapter 9, which is talking about introduction to substantive procedure, right? Now, remember the last time we looked at the test of controls, and I explained that test of control is or refers to the evaluation of the existing internal control system. Okay, you are evaluating the existing internal control system in order to ensure that the audit evidence that is obtainable from the existing internal control system can be relied upon. All right. Now, but in this topic today we are discussing, we are looking at the other side, which is the substantive procedure. Remember, I also explained to us that before now we used to call the two tests that are performed in order to place reliance on the audit evidence obtained from the client system. We call this compliance testing and substantive testing. I said that that has changed for now. And I said that now what we have is called test of controls and test of detailed transaction. All right. Now, the test of control, what we looked at last week. Today we are looking at the other side of it, which we call the substantive procedure. So substantive procedure is the makeup of two things. Two things make up the substantive procedure, and they are the test of detailed transaction and analytical review procedures. The test of detailed transaction and analytical review procedures is what make up the substantive procedure. Okay, so now we don't just perform the two tests, rather we perform three tests. Either you perform the test of control, you perform test of detailed transaction, and if you are not satisfied, you go on to perform substantive procedure. So substantive procedure is not a test per se. Okay, it is just a set of procedures, right, that are performed in order to ensure that there are no material misstatements in the financial statement presented by the management. Okay, so that is not a test. You still have your two tests, but the substantive procedure is a procedure that is followed after the two tests have been performed, that to ensure that the existing internal control system is is effective, and whatever audit evidence that is obtainable from that system can be relied upon. We talk about sufficiency and appropriateness when we were looking at audit evidence in chapter 6. Okay, we talk about audit evidence was sufficient and appropriate. The only way that can make the audit evidence to be sufficient and appropriate is when you make it to pass through what we call a substantive procedure. Substantive procedure is just an additional procedure that is performed in order to place assurance, okay, on the audit evidence that is obtained or that will be obtainable from the client internal control system. Okay, that is what I need us to know. So substantive procedure, like I said, they are what set of audit procedures that are performed in order to ensure that there are no risks of material misstatement or there are no material misstatements contained in the financial statement. I hope that is clear. All right, so let's go on. Now, you could look at it. That's what they have explained there. Now, when you're talking about substantive procedure, like I said, is it's a combination of test of detailed transaction, which is about evaluating. All right, it's about what evaluating the financial statement. So when you're talking about evaluation now, you're not only looking at it, you're not only testing the existing internal control system, rather you are collecting, you're obtaining evidence from internal control system and you're analyzing it. Okay, you are collecting information from the from the internal control system, and you are doing what? You are analyzing, knowing fully well that your internal control system is what we call internal control over financial reports. That means your internal control system is the bedrock of your financial report in any organization. So if your internal control system is weak, definitely is going to impact on your financial reporting. So the effectiveness and efficiency of internal control system is a major factor in determining whether the financial reporting that has been generated using the existing internal control system can be relied upon. All right. So, what are some of the things that the auditor will do? And the auditor will need to agree or reconcile the financial statement to generate the accounting record. Remember, we are looking at financial statement. You should be able to do what? Relate it to what? To the source document. Okay? Because the financial statements are a byproduct of what? The source document. So if you able to trace it to the source document and see that the figures that they have there is what can be relied upon. You also need to examine material journal entry. You know that sometimes when the auditor is done with the engagement, when they're done with the field work, when they're about to write their report, they normally pass, they normally pass they normally pass journal entry, which we call audited journals, right? All these journals. Now, those journals are to regularize or are to remove or reduce the risk of material misstatement that is contained in the what? In the financial statement. That is the essence, okay? That is the essence of the that's the essence of the excuse me. I think I need to reshare saying this thing. Sorry, I'm coming. I need to reshare. I'm not seeing what I'm sharing. Just a minute. Just a minute. Trying to share something. Okay, I hope you can see my screen. Okay. So what I'm saying here is that the auditor need to evaluate, okay, in the course of evaluating the financial statement, he needs to ensure that the all the tests, all the information that he has obtained or gathered from the financial statement, they are reliable. Then also where there are discrepancies or where he sees that what they have done is not right, okay, he will now advise them to raise journal. And that's the genesis, or that is the fallout, or that's what results to the audit journals that they say that the auditors pass anytime they come for what? They come for engagement. Okay. So the essence of these journals is to allow or is to make the financial statement to be free of risk of material misstatement. Risk of material misstatement. Okay. So that is what we need to know. Another thing you also need to know about substantive procedure is that how will the auditor be able to ascertain whether the financial statements are free of material misstatement? They need to have what we call, they need to test what we call financial statement assertion. They need to carry out what we call financial statement assertion. What do you call what are financial statement assertion? Remember, we have looked at this in chapter 6 when we talk about audit, evidence, and sampling, where I said that financial statement assertion are statements made by the management that the financial statements presented to the auditor are free from material misstatement. Take it again. These are statements made by the management confirming that the financial statements prepared and presented to the auditor are free from any material misstatement. That is what we call financial statement assertion. And I remember they also talk about the three types of financial statement assertion that we have. We said we have assertion based on transactions and events, all right? And we have assertion based on account balances, and we have assertion based on presentation and what disclosure. Remember, we talked about that. Now, that is also repeated here. But there's no way you are going to carry out substantive procedure that you will not test for what? Those assertions, because it is the management responsibility to make those assertions. It is the auditors responsibility to do what? To test those assertions, because it is the test that will make them to either validate, okay, or to set it aside and perform additional audit procedure to be able to place reliance on the audit evidence that is being what obtained, okay? So that is what we mean. So it's just like a recap of what we've done in chapter 6 when we talk about audit evidence and sampling. So we are going to still recap on those assertions, okay? So the assertions, the first one, assertion based on transactions or events, that relates to the statement of profit or loss under comprehensible income. Okay, that is, it relates to all those transactions that contain a statement of profit or loss under comprehensible income. So, in that regard, you'll be having to test this out occurrence that transactions disclosed in financial statement actually occurred. You need to test it. That those transactions presented or posted in financial statement actually what occurred. You need to, how will it test that? You will need to request for what? Source document. That's the only way we will know that those transactions are not what? Fictitious. Then completeness, that no transactions or events have been omitted. So every transaction that occurred within the organization needs to have been what? Posted. Then another thing you also need to test is the accuracy. So transactions in the statement of profit or loss comprehensible income must be tested that what? All the expenses, all those transactions have been posted correctly. There's no transposition, there's no transposition, there is no omission of any form in the information or transactions that are contained what in the financial statement. That's what we mean by accuracy. That is, you post correctly and you post promptly. All right. Then we have what we call cutoff. Cutoff is to ensure that you post into the what? Into the correct accounting period. You know that I explained that when I talk about cutoff. Now, cutoff, even in your payroll, they do cutoff. So when you do cutoff, you are trying to demarcate and ensure that there is no what? There is no duplication or there is no overlapping transaction or cost. Okay. For instance, your financial statement, you make it up, you prepare it at the end of every month. Let's say that is 1st December every month, right? December of 2023. Now, all those transactions that occurred within that December 2023 must not be posted in January 2024. Everything must be posted in December 2023. That will be by cutoff. If you don't go by that rule and you post some transactions that are meant for December in January, then that will allow for what we call risk of material misstatement. And that will have failed the assertion made by the management that they are free of what? Material misstatement. Okay? That's what we mean by cutoff. All right? I hope it's clear. Then we have the next one, which is the last one under this assertion based on transactions or events, which we call classification. So you must ensure that you post into the what? Into the right account. Okay. Remember, you have the chart of account. The essence of chart of account in an ARP or in an accounting package is to ensure that you do not post into the wrong account. All right. For instance, you work in manufacturing setup now. All right. The wages of those people that work in the factory that are responsible for the production of the goods, the finished goods, right? You will not put their own salary. You will not put their salary on. You will not put their salary on what we call um admin admin expenses. It will not be there. It will be charged under what? Direct wages. Remember in your manufacturing profit and loss account, we have what we call the prime cost, which is the elements are what? Direct material, direct labor, okay, and direct expenses. Those are the three that makes up your prime cost. So the direct wages is part of cost of production. Okay. So after you have your prime cost, you have some other indirect expenses, and you have what we call what? Your cost of production. Do you remember in your manufacturing profit and loss account? So in case you don't remember, I'm just trying to let you understand some of these things because there's no way you're going to explain audit that you will not touch on some other 14 papers, okay, that are contained at both foundation, skills, or professional. There's no how they are related, okay? So that's why I need to talk about it. It's not that I'm trying to say I'm going out of the syllabus, but I need to explain that so that you understand what I mean by wages of staff that are responsible for the production of finished goods and those that are at the back end, okay? Like those of us that are in the accounts department, um, IT department, we are not directly responsible to the production, okay? So we are the back end. So our salary will be under what? Admin expenses. We classify under what? Admin expenses. So what we are trying to say is that if you ensure that you post into the right accounts, okay? That will be by classification. Then we have the second type of assertion, which we call assertion based on account balances. When we talk about, I said that relates to your what? Statement of financial position. And there, you'll be looking at, the auditor will be testing those assertions made by the management. The auditor will test for existence. The auditor said that all asset liabilities and equity interest reported in the statement of financial position do exist at the reporting period. So all the auditor will test that those assets actually what exist, that those liabilities actually what occurred, and those equity actually what exist. Okay, so that's what we'll be testing. Sorry, and we'll be back. Okay, so I was talking about assertion based on account balances, and I said that relates to the statement of financial position. The author will be testing those assertions made by the managers as regards what existence. Okay, so for existence, they said that all the assets, liabilities, and equity interest that they actually exist. So the author will do what? We test the what? The existence. For assets, the author will request for what? The fixed asset schedule, right? And after that, you will now go for what? Physical verification, okay, of those assets. For liabilities, letter will request for what? Documentation. For instance, if the company has obtained a loan, letter will request for what? Loan agreement, okay, to establish that that loan, that liability actually what? Occurred. Then for equity interest, letter will request for what? Share capital certificate, okay, to request that, oh, they actually purchased there is a certificate for what? For ordinary shares or for preference shares, whatever shares that they have. Okay, that's what the auditor will test for it. Then for right and obligation, remember I said that is basically dwelling into two. I said right is the what? Asset, while obligation is the what? Liability. And I remember I said that when you talk about right, some organizations they don't have the the money or the fund to do what? To buy assets. What is an asset? An asset is what is used to generate what? Economic benefit. That is an asset, okay? According to IFRS, right? So when you now talk about right, so sometimes you may not have the funds, okay, to acquire an asset. What do? You lease the asset because you want the asset to generate what economic benefit to you. So when you lease the asset, you are going to be paying what we call lease rentals. Remember in your IFRS 16 leases, okay? You pay what? Lease rentals on it. And if it's higher purchase also, you also be paying your instrumental payments, okay? Instrumental, you'll be making those payments. So what that means is that if you are not the owner of the asset, so what you recognize in the stable financial position will be the what? The lease rental that you pay in form of those assets. Okay. That means the total value of the asset, the net value of the asset will not be contained in your book because you are not the owner of the asset. If you put that in your book, what you are doing is that you will be doing your organization a whole lot of disservice because when the tax authorities, when they come, they will charge you, okay, that you are not paying the right amount.
Hello, sir.
Yes, I'm with you, sir. Can you hear me? Go ahead, sir.
What figure do we put in the book?
Hello?
What figure do we put in the book?
What figure? In your statement of
Yeah.
financial position, you are going to recognize the lease rental, not the asset, not the net book value of the asset.
Okay.
Is that clear, sir? Are we clear, sir?
Yes, sir.
Mm-hmm. So if
Yes,
you are not the owner of the assets, if you are not the owner of the assets, you recognize the lease renters. But if you are the owner of the assets, you recognize the book value. Okay? All right. So then the next thing you are going to look at, we are looking at the rights, right? That's what you'll be looking, you'll be requesting for the agreement to show that they are not the owner of the assets. That's how the auditor will test. Now, for obligation is to liability. The auditor will request for what? The repayment schedule for loan. You took a loan from BOI, Bank of Industry. The request for what? The repayment schedule. To say that you are doing, performing your obligation, it's at when due. Okay, so by the time the SRA sees the um offer letter for the loan, okay, and he sees the repayment schedule, and he can see the name of the company on the offer letter, then they can establish that, oh, this loan is for this company. You also look at the duration of that loan, whether the duration of the loan has passed or has lapsed or not. You check for the duration period of the payment. All of these things are what we make the auditor to establish that truly there's an obligation to be made. Okay. Then we'll go to the next one, which is completeness. So for completeness, what we are saying is that remember in your sorry, trying to scroll up so that it will be you can see what I'm talking about. Now that I'm just be reading. All right. Coming. I think I've thing has jumped. Mm-hmm. Just a minute, I'm coming. I don't want to jump. Okay, then you have completeness also under the available based on account balances. So as regards completeness, right? The auditor will be looking at what documentation for assets, documentation for liabilities, documentation for what equity interest, and be sure that they have those transactions, assets, liabilities, and equity interest have not been what omitted. Okay, for instance, you bought a generating plant, right? And you only recognize the purchase price in your books. That's what we ask. By the time he sees the documentation, we know that okay, you have factored everything or you have not factored everything. The auditor will request for what? The documentation for the purchase of the generating plant, which you classify as what? Property, plant, and equipment. The auditor will be requesting for okay, this is the cost I can see here. What of the transportation? Have you factored that into your books? What are the cost of the commissioning and commissioning? Have you factored it? What are the cost of putting into use? Remember in your IAS 16, you talk about your property, plant, and equipment there, right? You see that you have those costs. You said that all the costs that you incur to put the assets to use must be what? Must be aggregated. So that means that it is not excluding all those incidental costs. All those incidental costs, logistics, transportation, must be factored in, must be added together to arrive at the total cost of the asset that is recognized in the books. That's what we mean by completeness. The same thing is applicable to liability, the same thing is applicable to your equity. Then valuation, if you go to your IAS 36, okay, 36 talks about what? Impairment. Impairment is that you must test your assets at least once a year against what? Impairment. So when you do your impairment test, the essence of it, you want to be sure that you are not undervaluing or overvaluing the book value, okay, of your assets in your books. You are not undervaluing it or you are not overvaluing. You are ensuring that you are putting the right amount that is there. And when you do valuation, you will be looking out for to be sure that the valuation was done by a certified independent practitioner, a certified independent expert. The person must not be a staff of the organization. The person must not be a consultant to the organization. Okay? Not that the person is the auditor. Not that it's the auditor that is still doing the valuation. No. It must be given to an independent expert, practitioner, or professional that will do that work. So the auditor will look out for the certificate that is issued by those experts that they actually did the work. It is the values that they have in the certificate that the auditor will be expecting to see in the statement of financial position, no other value. That is the value he wants to see. And all adjustment that need to have been done have been what? Have been carried out, have been posted. Okay. So that is for assertion based on what? Account balances. It's just like a recap. I'm doing like a refresher because they talk about it here and we need to look at it. That's why I don't want to jump. I don't want to gloss over it relatively and taking it gradually to be sure that we are all on the same page. If you have any question, any comment, any observation, please feel free to ask your questions, okay? Don't wait till the end of the class because sometimes some of these things you might forget. The questions, you want to ask questions. But once the question is brewing in your mind, okay? Please, you can ask me. So the other guy, when he asked the question, I was able to, I didn't wait for the end of the class, okay? So the last assertion is assertion based on what? Presentation and what? Disclosure. And that one is the combination of those assertions that you have in your statement of financial position and statement of profit or loss, other comprehensible income. Okay? Other comprehensible income. So you have occurrence. Remember, you have occurrence in your uh, assertion based on transactions and events, and you have right and obligation under your what? Assertion based on account balances. So the two of them merge together under the assertion based on what? Presentation and disclosure. So directors must we assert that they have obligations for the liabilities disclosed in the financial statement of financial position. Okay, so that is all those information that they have imputed in the statement of financial position and statement of profit or loss and other comprehensive income. They are what? They are correct. Okay, that's what we are occurrence, right, and obligation. They have completeness. So the auditor we also test that all the necessary information that is needed, okay, have been what? Have been considered and have been disclosed in the what? In the financial statement. Then you have classification and understandability. That is all information that needs to have a better understanding of how the financial statement has been prepared are contained in that financial statement. So anybody that approves financial statement, by the time you look at the notes to the account, because as you are reading financial statement, you'll be seeing notes. See note so, see note 5, note 6, note 7, note 8, you see all those notes there. By the time you refer to those notes and read those notes, it will give you a better and clearer understanding of how the financial statement had been prepared. Okay. Then you have the next one, accuracy and valuation. So that is, you see accuracy, we have it under what? Statement of profit or loss, other comprehensive income. Then you have valuation under what? Account, assertion based on account balances. Both of them are together. Together we test that all the information that they have in the financial statement, okay, and the appropriate valuation have been what? Have been disclosed, okay, in the financial statement. Okay, I hope we are together. So those are the assertions that we just reviewed again. All right. Now, when you're talking about this one is talking about how to go about when you have questions that relates to what test of detail. A test of detail, I told us that is the second test that is performed by the auditor, okay, to establish that they can rely on the what audit evidence obtained from the what from the internal control system. All right. So what he's saying here is that at every time that you are trying to carry out that test of the day transaction, you must ensure that you look closely. You take enough sample. Okay, you must ensure that you do what? You take enough sample from the what? From the existing internal control system. Sometimes your internal control system, remember, you've also been taught internal control. Some of the internal control system you have is your accounting system, it's part of your internal control system. Okay, so what we are saying here is that at every point in time, you must ensure that you take note of all those trends. You take enough samples, okay, from the accounting system to verify or to validate that whatever information that you are considering, okay, have been what have been validated and verified by you. All right. And what that also means is that before you can even carry out any test of detailed transaction, you must have gained understanding of the client internal control system. Then you must have gained understanding of the what? Of the client internal control system. To be able to establish that these are the key areas you will do what? You'll be focusing on. These are the key areas you'll be doing what? You'll be focusing on. Because if you don't have an understanding of what is key to the organization or to your client, then you might be doing what? A lot of what? Disservice or causing a whole lot of what? Audit risk to your client. Okay. And remember, we talked about audit risk earlier in the earlier chapters. So you need to ensure that you reduce the audit risk to the what? To the BRS minimum. So you must ensure that you have a proper understanding of your client's business. Okay. So one thing you also need to understand is that we are carrying out substantive procedure, right? It is an additional uh, test or procedure that you are doing. That is, you cannot solely rely on you cannot only solely rely on the test audited transaction. You need to combine it with your what? Analytical review procedures. So your analytical review procedures cannot stand alone. It's always an appendage to those two tests, the test of control and test of detailed transaction. But more importantly, with what? Your test of detailed transaction. That is where you have what we call your analytical review procedure. That is where it is what? That is what supports your analytical review procedure because at the end of the day, when you are performing your ethical review procedure, what you are trying to do is that you are trying to be sure that whatever information you have obtained as audit evidence, you have carried out other audit procedure to establish that the risk of material misstatement has been what? Has been reduced to the barest minimum. Okay. So some of the questions you need to ask yourself when you are um, being asked questions that relates to test of detailed transaction is that you must ask yourself this question. Number one, what are the areas that you need to test? You can answer this question is if you truly have the understanding of how the client business operates, then you can only know which areas are we going to test, which areas are we going to test. Another thing you also need to ask yourself, when overstatement occurs, how do you test it? How do you establish that there is overstatement? How do you establish that there is understatement? You can do this is by looking at what? Looking at the occurrence of the transaction and the existence of the transaction. That will throw more light whether there is an overstatement or there's an understatement. For instance, if you take a look at your assets, and let's say your property, plant, and equipment, and you saw the value that they have put down in your fixed assets register or asset schedule. And you saw that by the time you look at the original documentation for the asset, the figure there, the amount there does not tally with what they have on the system as the value for the asset. What do you do? That is either an overstatement or understatement. Okay? What do? You need to carry out further the procedure, ask the management that prepare the financial statement, and where necessary, pass all necessary audit adjustment journals, okay, to be able to what? To regularize those issues, okay? The other question you need to ask yourself again is how does the system operate and what document exists? Like I said, for you to carry out test audited transaction, you need to have a proper understanding of how the business operates. It's only when you have an understanding of how the business operates that you're able to ask the right questions. How do you know the right questions? How do you get an understanding of the client business? I talked about that in earlier chapters. One of the things you need to do is to obtain the what? The standard operating procedure of the organization. Every department has a standard operating procedure. But then you review the standard operating procedure, it serves as the manuscript of how the department operates or how the department function. Okay? So your understanding, you're reviewing the SOP will give you insight into how the business will operate. You'll be able to know what areas that are what that are needed to be what to be audited. Another thing you also need to know, remember in your chapter 2, when we look at obtaining an engagement in chapter 3, we said that you need to carry out what we call a preliminary audit risk assessment. And that assessment is done, okay, just for you to have an overview, to have an idea of what the organization entails. You remember I talked about that in chapter 2 when we look at obtaining an audit, obtaining an engagement. Okay, those are the area, those are the methods you can gain understanding of the client business. Then that will also inform you to understand what special tests are used for this area. Okay, you need to ask yourself question. What special tests are used for this area? For instance, you want to carry out, how do you validate your inventory? How do you validate your account receivables? One of the ways you can validate your inventory is to carry out what we call inventory count at the end of the period, or you request for the information, right, documentation for the inventory that they did at the end of the period. So that value you have there, you reconcile with what they have in the financial statement. If it does not tally, you ask questions. How do you verify your account receivables? You perform what we call what? Debtor secularization. You secularize your debtors and confirm, again those figures, whether those figures tallies with what you have on the system. Okay, these are some of the things that you will be doing when you are carrying out test of detailed transactions. Okay, do you have any question? Now, another thing also need to remember we look at we also need to look at the role all this software plays. And remember, all this software, what do we mean by all this software? All this software is a type of computer-assisted audit techniques. All right? All this software is what we call what? A type of computer-assisted audit technique, which I talk about CATs. All right? Now, these CATs, what do they mean? Now, these are methods of obtaining evidence. Okay? CATs are what? Method of obtaining evidence or information on the system that can be utilized for what? For as audit evidence. Text again. That are what? Method or approach used to generate evidence from the system, okay, that will serve as what? Audit evidence. That is what we call CATs, computer assisted audit techniques. And one of the types of computer assisted audit techniques is what we call audit software. Okay, all these software are basically used when you are carrying out what we call test of detailed transaction. Okay, when you're carrying out test of detailed transaction, you have what we call what? Audit software. That means that this software, just like you have your application on your phone, they are installed on the client server. Okay, and they monitor transactions online real time as they occur. So they monitor transactions as they occur online real time. And one thing you need to understand is that talking about all this software, it must have been prepared in such a way, right, that the whoever is going to utilize chat must have profound knowledge on what? On what we call SQL, structured query language. Okay, we're able to extract information because remember, your computer system, your server does not understand English language. There's what we call machine language. You must speak in that machine language for the system to reciprocate with what? Whatever information that you want to get from it. If you don't understand the machine language, you will not be able to extract information from the system. And this machine language, they are form of what? Syntax, okay? Computer language that you use, that makes you to what? Interact with what? With the computer system, all right? Without the understanding of the syntax or computer language or machine learning language, you will not be able to generate information on the system because the computer will not just respond, okay? All right? That is for software, right? Then we have three types of audit software. What we call the interrogation programs. What this one does is that it accesses the client files and record, okay, and extract data for auditing. So this one, the way I told you, I said that they are computer programs, they are machine language, they are programs that have been designed, okay, configured in such a way that once it is installed, they will just target your what? The client files and record and extract information for what? For auditing. That's what they do. We call it interrogation programs. Then you have interactive software. These ones are basically used in online IT system. Online IT system. For instance, if you go to Amazon now, or you go to slots where they sell foods in Nigeria. By the time you type in the URL www.slotng.com, whatever the address is, web address is, it comes up. When it comes up, there's a small chat box that pop up. The person will start asking you, how may I be of assistance to you? So when that thing comes up, it's form of we're trying to interact with you. Okay, that's what we mean by what interactive software. But in this instance now, we're looking at it from the angle of what audit. So the audit software is interacting with what? With the online system, trying to get what information, trying to access information from the client's online system. Okay. Then we have the last one, which we call the resident code or embedded audit software. Now, what does this mean? If something is embedded, that means that it is installed, it is affixed on the what? On the server. So what that one means here is that it's just trying to replicate all what I've been saying about this software, that it is what? It is always installed on the client server. At the end of this installation, is able to spool what? Process information online real time, okay, for the auditor. That is the essence of this uh, audit software, to be able to spool information online real time. So what are some of the examples, okay? So you use the audit software for account analysis, okay? What that means is that with your understanding of the audit software, right, you can use to perform what we call data analytics. Data analytics, you look at the trend of transaction, you look at the trend of expenses, you look at trend of the financial statement, you compare last year, this year, last year, this year, last month, this month, you do all those analytics, okay? You'll be able to have an insight as to the reasons for what, for those variation, okay? That's what you talk about, right? So you can also use all this software, right, to test your what receivable balances. Okay. So what you do is that you you look at you add up, right? After you have two things you need to do. First of all, you take the balances in your senior financial position, right? After you take your balances in your senior financial position, account receivable balances, you now circularize your debtors. When you circularize your debtors, you now compare it with what you have in the financial statement, whether it's the same. If there is any variation, you ask questions, okay? You will do what? You ask questions. Then what software can also do is that the software can be used to total the balances in the account receivable ledger, okay? And compare it with your receivable control account. You know, receivable control account is an account that is supposed to be temporal. And what I mean by temporal is that at the end of the day, that control account should be what? Should be zero. At the end of the day, there should not be any balance there. Where you have those balances in the control in the receivable control account, is for you to do what? To conclude on all your postings. Okay? For instance, somebody is owing. The person has not finished paying. You put it temporarily in the receivables control account. When the person finally pays, you transfer the balance, okay, out of that receivable control account into the respective ledger account. So that means at the end of the day, your control account, that's the receivable control account, should always be what? Zero. Okay? Should be what? Zero. If there's any figure there, that means that there's no proper reconciliation by the accounts department. That's what it means. That they don't keep proper recording or bookkeeping in that of that account. That's what it means. Okay. So the software, like I said, is deployed for test of detailed transaction. That is every aspect of financial statement. You can deploy the what? The software. Okay? Can deploy the software. So this is the example we are trying to look at. We're trying to talk about the receivables. So those are the examples. Okay? We don't want to bother with some of these because if you read it now, I think it'll be clearer because I've already explained what you be getting from that. Okay? Then you have a similar question here that will make us to understand better when you talk about all this stuff. They said that you have been in charge of the audit of inventory of kitchen magic, a wholesale of kitchen goods. Magic keeps a permanent record of inventory on its IT system and carry out a running program of inventory counts to check that the record on the system is reflected by actual goods held. Year-end inventory will be listed for you, showing for each product, date and last purchase, date of last sale, cost, selling price, quantity, and year-end valuation. This schedule will be available on the last day of the year. Required. Use the test that will be performed by audit software, which will assist you in your audit of what? Inventory. This is a typical exam question. Okay. So first of all, what you need to do is to get what? Your year-end inventory schedule. What I mean by inventory schedule is that there are sometimes you don't have just one product, you don't have just one item as your inventory. You create all your what? Inventory schedule. Okay? Then what you do, list out all items over a preset amount, at least the materiality threshold. Actually, threshold. Remember, what you're trying to tell you now is that you remember you talk about materiality when you're talking about audit planning. Yes, any question? Okay, talk about audit planning, and I said you said what we call overall materiality. Before you now come back to what we call performance materiality, remember, so you need to set that overall materiality at this point. Okay, then the next you need to do is for each item on the schedule, multiply the lower of cost and selling price. Okay, times quantity, and list out. What they are saying here is that you know that for inventory, you say that you value it at lower of cost or what? Net realizable and net realizable value. So lower of cost and selling price. Net realizable value is the selling price. I hope you still remember your IAS2 inventory. Multiply by the quantity and list out the items where the figures does not agree to the year-end valuation. I hope you get that. Then compare the prices of those in the current sales price master file. There is a you have a current sales price master file. That is the price that it originally was set, that was approved by the what? By the management before any subsequent adjustment. Okay. So you now compare. Then list out any item where the date of the last purchase was more than say a month ago. You know that the current sales price master file contains the list of the prices of all the items in the what? In the organization. All the items that they normally sell in the what? In the organization. So, and within the course of the month, there could be some variation. Maybe because of one thing or the other, there's an increase, there's an upsurge, they increase the price. So, you now take a sample from a month, okay, at least a month, and try to compare it with what you have in your watch, in your current master file. That is the price before any change or any changes occur. Most of these things are better done practically, okay? Are better done practically, but because of time and because of the way the lecture is, okay, I will just try and explain it in this way. If you need further clarification, right? Maybe there will be need for us to maybe I will need to do a demonstration, okay, and share it on our WhatsApp so that we can have a better understanding of how this thing will play out because this can only be practicalized if we are seeing it, how these things what are being done practically on the system. All right. So like I said, just listen. If there's a need for me to do that, just signify it in the WhatsApp group. I will try and do like a demonstration of this particular question, okay, and see how I can put it in form of a slide presentation, okay, so that we can have a better understanding of it, okay. So let me not bore us with too many questions because time has fast spent, right? Okay, it's already 9:29. Okay, it's almost 9:30, and we still have how many hours to go? We have not gone far. So this one, like I said, I'm going to do it a presentation for us. It's an example that can be tested in exam or during exam. I'll do like a presentation for us using slides. Okay, I hope that will make it clearer. Okay, so you just remind me at the end of the class. So some of the problems you have with all this software is that when it is being used for the first time, okay, the setup cost is always high. The cost of procuring it, the other software is very, very expensive. Why is it expensive? Because it's mostly in foreign currency. They are not denominated in naira. Number two, so when there's a change in the accounting system, let's say you change from QuickBooks to Navision Dynamics, okay, ERP. That means the software we need to what? We need to change. That's another cost on this one. Number three, there may be problem with producing suitable software, okay, when the client has an old purpose written. So what this one is saying here is that when the client you are working with is using like a legacy system, legacy system are very old accounting system. Okay. Now, by the time you try to integrate your other software with the legacy systems, most times they are not what? They are not compatible. Most times they are not what? They are not compatible because legacy systems are very old version of an accounting system. So, and you know that your other software is basically working. If the foundation of your other software is strictly accounting, is making use of what? Excel and the likes. So where the legacy system does not fully integrate with the other software, and that means that it creates what we call incompatibility. Okay, and that will not achieve the aim of the what? Audit software. I hope you get that. And you know that audit software, like I said, is it goes into the system, try to understand how the system operates based on the way it has been programmed, because it's a set of computer programs, set of computer instructions, okay, or programs that have been configured or, or designed to extract information from the client server. That we call it. Then we have another one which we call audit around the computer. This one is opposite of audit software. Audit around computer is that this one is only looking at what? The input and the output. It's not looking at how the input is being transformed into what? To generate the output. This kind of audit does not it has its own limitations. Why? Because the editor will not is not interested in understanding how the input was processed to transform to the output generated. The editor is just concerned as to the input and output. And this one of the major challenges of this is that sometimes you might not be able to establish, okay, whether the processing facility or processing element of that computer is actually achieving the what? The needed what? Objective. You're not able to establish because you don't have any evidence. You have not been able to tinker around looking at the system. You are not even interested in looking at the system. You are just concerned as to your input. For instance, you put in one on the computer, one plus one, you put it on the computer, you now expect two. You don't understand, you don't want to understand how the two came about. That's not your problem. You're only concerned as to one plus one and put on the system. And the result is what? Two. How do you arrive at two? None of your business. You are not concerned. That we call what? Auditing around the computer. All right. Now, another thing that you also see is that sometimes you also have what we call what? The actual files, okay, and programs are not what? Are not tested because what you are doing, you are just doing it outside the box, outside the what? The computer system. You are not opening up the system. You're not trying to understand whether there's what we call arithmetic logic unit, processor, and the control unit. You are not concerned as to that. Your own is just the input, the keyboard, the the monitor. Okay, how you are working with your visual display unit, which you call the monitor. And you're looking at what? Your printer. For what? For the output. That is all. You are not concerned as to how they arrive at those people. That is not your business. That's none of your business as an auditor. Okay, that's what you mean by auditing around the what? The computer. Okay, now remember also in chapter 6, we look at method of obtaining evidence from what? From the client environment. We still look at that here. I'm saying we are still going to refer to those 7 methods, okay, of obtaining audit evidence. Number one, inspection. Okay, this can be done by what? By by inspecting, by checking the status of an asset. Okay, mostly for tangible assets and also for your inventory. You check the what? You check it. You check the status. For instance, for your asset now, you need to check whether those assets actually exist. You need to inspect them. You need to go for asset verification. Okay. Then for your inventory, you might need to also check them because sometimes the value, the expiring date, the product would have what, the inventory would have expired. So you need to go and check them. Number two is observation. You use observation when you by watching, you just observe. And this is normally done when you do stock count. When the estimators come for when they visit, when they are present during stock count, one of them will just be observing. While others are doing the counting, one of them will be observing how the counting is done to be sure that no procedure or process is left out. All right. Then you have inquiry. Inquiry is ensuring that asking questions. Okay. You ask questions. You say whoever asks questions will not miss his way. So the auditor will always ask questions. By asking questions, is gaining understanding, is seeking knowledge, okay, of how the system works, operates. They have confirmation, external confirmation. This is where the auditors seek confirmation from outside professional, okay, or professional outside the entity. Most especially the what we call the experts, surveyors, architects, engineers, risk management consultants, IT consultants, all these people we call them what? Experts, okay? Then we have what we call recalculation. Later, we need to check the arithmetical accuracy of documents and record being presented. Sometimes there could be omission. Sometimes when they school financial statement from the ERP or the accounting package, sometimes you need to recalculate the value, the balances, okay? The grand total. You need to check everything like everything is what? Is still intact. What do you mean by recalculation? Then you have reperformance. Reperformance is when the auditor tries to check whether the original control put in place are being complied with. Okay, so what that means is that the auditor would have asked questions. He's able to satisfy himself that this is what is obtainable here. But for him to be convinced, you need any reasonable doubt, or what we call what a reasonable assurance. What he will do is that he will he will request that he is permitted to initiate a transaction using the what? Using the ERP. Why is he doing so? You want to establish that all those checks and balances, all those control procedures are not what? Are not being flouted, okay? Or are not being are not being omitted in the course of what? Processing. All right. Then another thing we also need to do is what we call analytical review procedures. And that is the essence why we are discussing this topic, analytical review procedures. This shows possible relationship between financial and non-financial data. Okay, that's what we mean by analytical review procedure. So what that means here is that you now ask a question: how will you establish that the data evidence is what is reliable? How will you establish that the data evidence is what is reliable? Then the auditor we need to base is what is reliability on these 5 generalizations. Okay, the author will base is reliability on this what 5 generalizations. The fourth one of the ways the author will test the reliability of audit evidence is to say that audit evidence obtained from an independent source is more reliable than audit evidence obtained from within the entity. Audit evidence obtained from an independent source then what more reliable than audit evidence obtained within within the entity. And that is true. Because you are waiting for information you want to obtain from within the entity. Sometimes that information is always what? Doctored. Because you don't know what extent you want to use that information. But for somebody that is outside, for an expert outside, it will give you everything that you need because it doesn't know which information you will need more. What will it do? It will give you all that you need. So that means you are tempted, or you are assured of getting more reliability when you rely on information you get from an independent, knowledgeable third party than from within the entity. That is one of the reliability tests for audit evidence. Number two, externally generated audit evidence is more reliable when the related controls are what are effective. Remember, I talked about internal control over financial reporting. If internal control over financial reporting is weak, then all the financial reporting that has been prepared, okay, or generated would not be able to stand what the test of time. Why? Because it will be what considered as what containing risks of containing what material misstatement. The risk of material misstatement will be what will be very, very high. Okay. Number three, audit evidence obtained by the auditor, okay, is more reliable than audit evidence obtained indirectly or by inference. What that means is that the evidence that the auditor himself or herself obtained or generated or gathered, okay, they are more reliable than any evidence obtained indirectly or by inference. All right. So if you are the one doing the audit, because you have an understanding of how the business operates, you know which areas you have to focus your attention on. So that means that your information you have gathered is tend to be what more reliable than any other information that you watch that is presented to you. Number four, audit evidence is more reliable when it is in what in documentary form than when it is what in an oral form. Oral form can easily be what be denied. All right. Oral evidence can easily what be denied, but documented information cannot be denied because there's a proof. Okay. That's why auditors always request what we call documentary evidence. Then you have another one which we call audit evidence obtained by original document is more reliable than audit evidence obtained in photocopies. There's what we call Oluwole somewhere in Lagos, years back, where is the center or headquarters for what? Counterfeit. Okay? They still exist now. The community still exists, but they are not as profound as they used to be. Okay? So that's why auditors always request for what? Original documents. Original will always be one. You cannot have two original. It's only one original. Okay? But photocopies can be several. All right? That's what we mean. So that's why auditor always request for the original document. That's how the auditor will carry out the test to be sure of the reliability of the audit evidence. That's what we call, does anybody have any question? We move to the next one. Any question, any comment, any observation? Any question, any comment, any observation? Are we good? Okay, so let's continue. Let's fire down. I will look at the next one, directional testing. What do you mean by directional testing? Directional testing is a type of audit approach, okay, that focuses on what we call the principles of what? Double entry. Is a type of audit approach that focuses on what we call the principle of what? Double entry. What am I trying to say? What I'm trying to say is this. This approach states that if there is a variance, okay, if there is a variance on the debit side of your trial balance, right? The this approach confirms that there will always be a corresponding variance on the debit side. So if there's a variance on the credit side, there's every tendency that there will be a variance on the credit side. That is what we mean by the double entry principle. That says that for every debit entry, there's always a corresponding credit entry. That is what we mean by double entry principle. Okay. But when we are talking about directional testing, we are saying that if there is a an error, okay, on the debit side, you will always, if you look closely, you're going to see the second leg of that error on the corresponding leg or the corresponding side, okay, of the next of the same error on the debit side. For instance, say there's an error on the debit side, okay, you always see another error on the credit side that balances out. We call it what? Directional testing audit approach. The advantage is number one, it helps the auditor to clarify the audit objective. That's what it's used for. What that means is that when you carry out audit directional testing, it's simpler because you don't waste time. Once you see an error, you are trying to do some verification, okay? You find one error at one side, on the debit side or on the credit side. If you do closely, you're able to obtain the second leg of that error. All right. Then number two advantage, it focuses the audit work on areas of high audit risk. So for you to use directional testing, you always focus on the what? The high audit risk. Okay. So where you have high audit risk, what do you mean by audit risk? The risk of what? Giving a wrong what? Audit opinion. That is audit risk. So when you say high audit risk, it means that the essential that the audit opinion will be what? Will be incorrect. The use of giving an incorrect audit opinion, that's what we call audit risk. When you say you have high audit risk, it means that the audit opinion, there's high probability that it will be what? Incorrect. That means that if you look at what are those areas where you have high audit risk? Most importantly, if you look at the assets, the current assets, that is inventory, receivables, um, cash and bank, okay, they are prone to what? High risk, okay? Then it links together the result of audit test. That's another one. It links together the result of what? Audit test. So all the tests that you have done, by the time you observe that you saw an error on the debit side, then you look closely, you see the error on the credit side. So all the tests that you have done, if the auditor is knowledgeable about the engagement, the error will be what? Will be minimal. Okay? You'll be able to what? Be able to discover or detect any of those errors that may have impact on the what? On the financial statement, which we call what? Material misstatement. Okay? List of material misstatements. Okay? So that is that. They're not done yet. Still going forward. Remember, I said that when you talk about high risk audit, high audit risk, you see what I said? It relates to what? Your assets, okay? Your liabilities, expenditure, and the combination of all of this. So, example, they said, if non-current assets are overstated by 5 million, but the trial balances, then one of the following errors must have happened to explain how the situation has arisen. As if you have your non-current assets overstated by 5 million. These are the possibilities because you know that your trial balance is from there you extract figures for your financial statement. Those that don't know, the trial balance is a test of identical accuracy. So all your ledgers will filter into your what? Into your trial balance. Then from your trial balance, you generate your financial statement. So if there's an error in your statement of financial position, if you look closely, right, you will see that your trial balance, either you have understated your asset by 5 million, or you have overstated your liability by 5 million, or you have overstated your income by 5 million, or you have understated your expenditure by 5 million, or it's a combination of all the possibilities that I've just explained. All right, that is what we mean. Now, when you are testing for overstatement, okay, so what that means is that the direction of testing, that's directional testing, okay, is then backward to the source. What that means is that when you observe there is a overstatement, what do? You go back to the what? The source document to check the source document, book of original entry, your invoices, okay, your LPO, okay, your sales order. All of those are your book of time entry. You go back and trace those figures from those documents to be sure that it is what? It is all correct. All right. Then, if you look at if you are testing for understatement of credit balances, then That means you'll be tracing your transactions forward, okay, to the financial statement. So what you are trying to ensure is that you'll be looking at your what? Let's say there is a understatement in your credit balances. So you'll be looking forward to your looking at your what? Your dispatches, your delivery notes. Okay? If there is understatement of your credit balances, that means you have sold, then your inventory is what? Is less. Okay? You saw that your inventory is what? Is less. So what do? You look at your delivery notes, whether you have you have delivered more than you are taking more quantity than what you should have taken out from the store. All right, that could be responsible. All right. Then another thing that we also need to do is what we call perform analytical review procedures. And I explained earlier that analytical review procedures has to do with what? The possible relationship between financial and non-financial. What do you mean by possible relationship? That is related relationship. That is, information must be related, both financial and non-financial. That is, what we're trying to say is that if you look at any financial, if you look at any organization, let's say there is a fraud, there's always the non-financial angle to it and the financial angle to it. Most times, it's the non-financial angle to it that results in the financial angle to a fraud in your organization. Okay? For instance, you have somebody that has been that they've not done proper background checks for, and you started that person with a lot of responsibility. For instance, that person is your chief accountant or your CFO or is your treasurer, is your cashier. You don't do background check on such individual. So if the person has a criminal record, how do you know? How do you detect? So because you did not do proper background checks, which we call the non-financial uh, information, it will lead to what we call financial information because the person will perpetrate fraud. That's just a type. All right. So that's why we always say that the non-financial impact the what? The financial. Before any financial can take place, any financial effect can take place. Go and check. There's a non-financial that has occurred that has not been what? Detected. All right. What you need to know is that your annual review procedure start at also at what? At the planning stage. You need to understand that annual review procedure is also documented, it's also commenced at the planning stage. All right. And you need to understand that the annual review procedures is not standing alone. It's a support, it gives support to other audit evidence that have been what? That have been obtained. It's just to verify that the right thing has been what? Has been obtained. The right information has been what? Has been gathered. All right. Then another thing you also need to know is that for your entry review procedures, you must be able to identify the high audit risk areas. High audit risk areas is where you're going to focus your analytical review procedures on. By analytical review procedures, like I said, examples, you have the ratios. You know the ratios, they call them the indicators. When there is a problem in any organization, they are the indicators, they are the pointers to show whether the organization is LD or the organization is on LD. When you compute the ratios of the organization, you'll be able to establish whether the organization is LD or not LD. That is one of it. Another example of anti review procedure is when you perform what we call trend analysis. You look at the performance of a transaction, let's say revenue or your expense over the years, over the months. You see the movement. You look at the variation. The variation is quite significant. The times that you need to ask question why there is so much increase. Okay, for instance, you have your revenue figure for 3 years, 2021, 2022, 2023. 2024, you don't have it. But you agree with me that because you don't have 2024, does not mean that you cannot project what 2024 sales revenue will be. Okay, so what do? You use your trend analysis. Look at the performance of your organization in 2021, 2022, 2023, and predict what your 2024 supposed to be. All right, that's what we mean by uh, trend analysis. Okay, because you have year one, year two, year three. You are trying to get year four, which from your year one to three, you can deduce what your year four will be. All right. Hope we are all together. So, like I said,
Yes, sir.
is it, I hope so. It means that at the anytime you are trying to carry out an review procedure, it is not a standalone procedure. It is a supporting, it is additional audit procedure. Let me use that word. This is an additional audit procedure to validate that the audit evidence that you are working with is what is okay. All right. That's what we have here. So you have all what I've said now is that is contained here under analytical procedures, ISA 520. You can see they say all the evidence generated is what supplementary to evidence gained from other audit testing procedures. You see what I said? Just a recap. Okay. Okay. You can see the second one. Second objective is to ensure that the reported figure makes sense in the context of what known business facts. That is, you're able to establish that you don't have a risk of material misstatement. That's another reason why you have the you perform what we call the analytical procedures. Okay. And look at some of the things you'll be looking at. I've already explained all of this. Look at them. Ratios. Look at them here. Ratios, trend, and relationship of the current financial year as compared to the prior year. Like I talked about last year. I talked about 2 months ago. You've seen them here. Prior year, budget and forecast, predictive estimate. I've talked about all of this, okay? These are some of the things you'll be what? You'll be looking at. Then we'll go on. So like I said, they say are used relationship are used in analytical procedures to analyze items financial information. Okay, that is, you use it to predict the pattern, like the revenue I talked about, your gross profit. Okay, when there's a significant change, what you mean last 2021 you made 100 million, 2022 you made 80 million, 2023 you made let's say 150 million, in 2024 you're not saying you want to make 500 million. That's going to be very, very massive. Okay, it's going to be very significant. Okay. So what we are saying here is that they must be used in planning the nature, timing, and extent of audit procedure. That is the analytical review procedure. Also, they must be used as what? Substantive procedure. You know, I said that analytical review procedure is more utilized. We are talking about what? Test of detailed transaction. Okay. Then it must be used at the overall review stage to allow the auditor to conclude whether the financial statements as a whole are consistent with the knowledge of the business. So when you are done with your engagement, you need to perform analytical review procedures to establish, okay, that the information contained in financial statement can be what? Relied upon. Why? Because they are what? They are consistent. Okay? Because they are what? They are consistent. All right? So you have also in an exam, okay, like I said, this topic we are discussing is a likely examinable area, and most students do not like this area. You can see that it's more practical than other ones that we have talked about. You need to be practical with this for be able to be able to what drive sense or to be able to make meaning to the students. Okay, so what we are saying here is that when you have a question that relates to analytical review procedures, please, I know that we said that there's no calculation in audit, but please, if you have a question, for instance, you see that they give your audit and assurance, they present you financial statement, right? If you look at the financial statement, sometimes the requirement will be in the direction of what? Asking questions relating to what? Analytical review procedures. So when they ask questions that relate to analytical review procedure, what they expect you to do is for you to do what? Compute ratios. Okay? Compute necessary what? Ratios that you can see based on the information provided. Or you do what we call trend analysis. Okay? You do what we call trend analysis. Or you do what we call what? Net change. What do what do I mean by net change? When they give you a financial statement, they always have the comparative figure there. What do I mean by comparative figure? You're talking about year 2023. You always see 2022 there. Let's say 2022 sales, you had 100 million. 2023, you had 80 million. That 2023, there's a reduction in your sales value. That is minus 20. Abi? 100, 80. 2023, I mean 2022, 100. 2023, 80. There's a decrease of what? 20. That's minus 20. So that's what we mean by net changes. And you do that across all the information that has been what? That has been presented to you. All right. So you'll be looking out for significant change in your gross profit margin. You look at significant increase or decrease in your administrative expenses. You look at a significant increase or decrease in your selling and distribution expenses. You look at your significant increase or decrease in your interest cost or your investment income. You also look at the significant change in the net profit margin. Remember, that's what we call net profit margin. Okay, you have gross profit margin, then you also have all these other ratios. Okay, that is a function of what? Whether revenue or it will be as a result of what? Cost. Okay, cost of sales. So you need to look at all of this. Okay, some of the ratios that is what we use amongst our what? You determine your payroll cost. You look at your payroll cost using what? Ratios. Okay, from your ratio, you can show whether the payroll cost should be what? Reasonably, it should be reasonable or justified. That is, you need to increase salaries, or why did you increase salaries of new staff, or you need to increase salary of new staff to reflect the current trend. For instance, now, you look at most organizations now with the current inflation in the country, even though for August 2024, the inflation rate dropped. Okay, it dropped by a few percent. It's not up to it's still a single digit. It dropped by a single digit. So what I mean is that it dropped from, let's say, from 30 something, 34 or 35 to 32. Okay, so that means there's a 3% drop. The effect is not significant yet. Okay, but what we are saying here is that if it continues, if this drop continues till the end of the year, there's every possibility that we are going to start seeing the effect of reduction in what? In prices of goods. Okay? We are going to see the effect of what? Reduction in what? Prices of what? Commodities. Okay? And that will increase the what? The purchasing power of the citizens. You understand what I'm saying? So you need to look at the payroll, all right? You look at your payroll cost. You compare it with the um, last month. How much did you pay last month? How much are you paying now? All right. You look at your payroll. So sometimes when you're looking at your payroll, you can look at it vis-a-vis your profitability. You can factor your payroll vis-a-vis your what? Your net profit to see whether the payroll, there's a possibility that you can increase your payroll at the end of the month. Likewise for other expenses as well. Also your working capital, your asset test ratio, your quick test ratio, your asset test ratio, okay? You need to also test that also, all right? Then you have further example here. They say you are currently planning the audit of Numero for the year ended December 2024. You are aware that the revenue was budgeted to fall by 20% from last year. Further information was made available. This is the information required. Explain which of the above amounts you believe might need further investigation and why. Okay, so what that means is that you are going to look at the information given to you, just comparative 2023, 2013, 2014. You have revenue, you have cost of it, you have expense, you have trade receivables. That's all that you are giving. They are now asking you required for me. Explain which of the above amounts you believe might need further investigation and why. You need to look at them one by one. You start with the cost of sales, okay? So you look at cost of sales. Do you have cost of sales there? Sorry, I'm coming. Look at cost of sales. 2013, 300. 2014, 300. It did not change, all right? So that one is a little bit is constant, right? That's what you're going to answer. Cost of sales has remained constant and yet revenue has fallen by anticipated 20%. So cost of sales will generally be expected to move in line with revenue. Okay. An alternative comment would be that the gross profit percentage has fallen by what? Has fallen from 40% to 25%. I hope you understand how they did this calculation. What will be your base year? Your base year will be your year 2013, and your new year will be your 2014 times 100. That is one way to compute the what? The ratio. All right. That's one way to do what? To compute the ratio. So let me just see. Another way you can compute the ratio is look for the difference and divide by the base year. The difference between this one is uh 100, okay? The difference between 500 and 400,000 is 100. So 100 divided by 500, okay? That's 20%. I hope you understand. Sorry, you are doing calculation. There's no, we said there's no calculation in audit, but we just pray that they will not bring calculation, okay? That's the essence of this, that's the essence of this 20% that we talk about here. 20% that you have here. Okay, revenue, okay, 20%. They now said that another comment will be that the gross profit percentage has fallen from 40% to what? 25 percent. So what that means is that you look at the difference between the two. For 2013, you have 200. That's the gross profit. That is revenue minus cost of sales. Then 2014, you have 400 minus 300. That is 100. Okay. So that means you have the difference between 200 and 100 is 100, right? So we have 100 divided by 200, right? Times 100. You have a 50%. All right? You have 50%. I'm just trying to look at the calculation, okay? So we are looking at what alternative comment will be the gross profit percentage has fallen from 40% to 25%. So what that means here is that if you look at the gross profit for 2013, what do you have? Like I said, is gross profit is that is 500 minus 300. That's 200, right? Gross profit is always as a percentage of what? Of your turnover or revenue. So you have 200 divided by 500. That is 40%. I hope you understand. Your gross profit margin, remember your ratio. Gross profit margin is your gross profit divided by your revenue. Okay, you do that for the 2 years. All right, if you do for 2020, 2014, the difference you have here is what? That's 100. That's 100 divided by 4. That's 25. 25%. That's how they got the 40 to 25% that you have here. You understand? That is the calculation. And you are going to do same for expenses. So for expenses, they say that expenses have decreased. Expenses have decreased by 60%. This could be due to the fall in revenue, or it could indicate a misallocation between cost of sales and expenses. So what we are saying here is that the expenses has what? Has reduced by what? 60%. So what do we have here? So expenses, what you have in 2023, 2013 is 50,000, right? You have 50,000. Then in 2020, 2014, you have 20,000, all right? That's what it means. So what they're now telling us is that it has dropped, okay? From 2013, you have 50. Now you now have what? 20. That means there's 30,000 drop in it. That will now be 30,000 divided by 50. Do you understand what I'm saying? Your base year will always be 2013. Your base year will always be what? 2013. So that is 30,000. That is 50 minus 20. We give you 30. 30 over 50. We give you 60%. That's what they mean that there's a decrease in what? In expenses by what? 60%. You do same for your trade receivables. Your trade receivables, you are going to do your this is calculation. You're going to use your trade receivables, your balance your trade receivables all over revenue times 365 days. Okay, your trade receivables. Let's do it. So you have 30 divided by, that is 30,000 divided by 500 times, for me, times 365. You have 21.9. That is 22 days. I just want to show you how the calculation is going. Look at it here. 22 days. Okay. I said is your trade receivables all over your um your revenue times 365 days. So this one for 2014, it will be what? 60 divided by 400 400 times 365. That will give you 54.75. Okay, that will give you 54.75. Okay. And that's how you have your 55 here. They rounded it up. That's how you have it here. It will be in days. Okay. This may indicate a change in credit terms. Okay. What that means is that for the um trade receivables, okay, if you look at what you had in 2013, the trade receivables was what? Was 30. But in 2014, it has doubled. What that implies is that there was been an increase in your credit policy. That is, normally they tell you that if you buy within 30 days, if you pay within 30 days, you are going to enjoy discount. Okay. But now they are saying that if you pay within 15 days, okay,
Hello,
what they have done is that they have increased the number of days. They will not tell you that I'm going to pay within 30 days, they tell you that pay within what, 60 days or so that you have enough time, okay, to sell. After you sell, you now send your money to the organization so that the company can continue to what? To produce. Okay. So some of these things, like I said, this particular topic, I must tell you, is very, very practical. It is not theoretical, it's practical. Okay. I don't know
hello,
if
sir.
you're able to understand what I've been explaining since on this particular topic. Yes, I'm with you, sir.
So please, is there any way you can probably just solve this percentage that in this answers? Please
And send
Yeah,
it to
just
you.
yes,
Okay, no
send it
problem.
to
I'll send it to
me.
you. It's not a big deal. I've done it here now, but you're not catching up, right?
Yeah, I'm catching up. Just I
someone
I
might
understand.
forget. You understand?
No problem. I'll do it and send it to you. Okay?
All right.
I'll do it and send it to you. So that is all on substantive procedure. Introduction. This is just introduction. Okay? We're going next to substantive procedure as regards your non-current assets. Okay? We are going to look at your assets totally. So we're going to look at your non-current assets and your current assets. Okay? Next time. But this one that you said now, I'm going to solve it. Okay? And send it to us. By tomorrow you have it, okay? So you'll be able to look at the notes I sent to you and be able to interpret the solution you have there. It's not, this is pure arithmetic, it's not further maths, it's just pure arithmetic, but I can understand and I appreciate your sincerity. I will send it to us, okay? So thank you so much. Is there any other question before we wrap it up? Any other question?
yes, no question. Just a reminder, you were talking
Yeah,
about one calculation to send as well when you first
yes,
started.
yes.
So
Which
you can
one?
send it together.
Which one is that?
I
Sorry.
mean, there's one calculation you were talking about that
Okay,
you're going
okay,
to.
okay, okay. I'll try. That one is an analysis. It's in form of an analysis. I'll also send
All
that
right.
one to you. No problem. All right. Thank you so much. Any other question, comment, observation?
Hello, sir.
All right.
Okay.
Thank you so much.
Hello.
Thank you so much. Yeah, I'm with you.
Okay, sir. This class, is there any way we can access it on YouTube and rewatch, or is just one time thing?
No, no, it's not one time. They'll send the recorded version to you people now on the platform. At the end of the class, by tomorrow, just
Like
request on the
okay,
platform.
like the previous
They will,
class, I was not chance
they've
to.
not send it, right? You said what?
Yes.
Don't worry. Just put it on the platform. The respective parties. The responsible parties will attend to it. Somebody requested for the previous notes, lecture note that we have discussed today. I told the person go to the platform and put it there. They responded, right? The person was able to get all the notes from chapter 1 to chapter 9
The
that we are discussing now. So please, tomorrow, put it on that platform. The responsible parties will get back to you on those recordings, lecture recordings for what we have done, all that we have done so far that has not been sent. They'll send it to you. Just put it on the platform and say kind reminder. Would that be clear, sir? Would that be
Thank you.
fine? Would that
Yeah,
be all?
thank you.
Any other question? Any comment? Any observation? All right, that means we are all good. Thank you so much.